Good evening to everyone present here today. We have our product manager Jason D'Souza who will help you understand why ELSS is the best way to save taxes and how to pick the ideal one for your investments. Towards the end, we would also be having a Q&A session. Over to you, Jason.
A very warm welcome to each and every investor present here in today's webinar. Tax planning is the most least prioritized part of our financial planning journey. And the reason I make this statement today is when you see the number of people who file taxes towards the end of the financial year in March, or you see the number of investments in ELSS coming towards the end at March, you would get an answer to this. In today's webinar, I'll be talking about ELSS mutual funds. What exactly are they? Without wasting any time, let's start off this particular disclaimer. Investment in securities is subject to market risk. Past performance should not be construed as a guarantee for future returns. Okay, so before I was making this topic, it's not really vast, okay? I'll be talking about 6 different things today. If you just share my screen, I'll just show you the 6 different points. The first one is, what are the options for tax saving under ATC? Is ELSS the best one out here? What are the other different ones? What's their lock-in period? So on and so forth. The second point is, what exactly is the ELSS mutual fund? How are some of these ELSS mutual funds performing today? Okay, moving on, when and how you should invest in ELSS mutual funds. Okay, people normally invest towards the end of the financial year, as I mentioned, but can we have some strategy when it comes to this particular thing is what I'll also be covering. Okay, some of the top rated ELSS on Markets Mojo, what is their ranking? And lastly, strategies to maximize your ELSS investments. Okay, these are like 2 different strategies I found out, and you cannot only apply them on ELSS, you can try them across different mutual fund schemes. So let's get started. The first one is the ATC investment options. What are the different instruments we can use when it comes to getting some tax rebate when it comes to ATC? Okay, so the first one is National Pension Scheme. What I've done is that I've written the average expected returns, which is 7 to 8%, and the lock-in period. Now, as the name suggests, National Pension Scheme, it's locked in till 60 years of your age, and you're getting a continuous 7 to 8% CAGR on your returns. The second one is Unit Link Insurance Plan, which is ULIP, a mixture of both, like an insurance plan as well as some equity returns. So you're getting some 10 to 12% in this, and the lock-in period over here is 5 years. Okay, the third one is Public Provident Fund, and I think after ELSS, this is one of the most selected classes when it comes to investment options. We have around 7 to 8% average returns here, but a 15-year lock-in period. So the money you put in this PPF instrument will be locked in for 15 years. Okay. Then we have Sukanya Samriddhi Yojana. Okay, this is something for the girl child, and the returns over here is around 8.50%, and it's up to around 21 years after you start this account. So this also has a very high lock-in period. Okay, we also have National Savings Certificate, which is very similar to a National Pension Scheme, which has 7 to 8% return, but a 5-year lock-in period itself. A tax saving fixed deposit, you're around 6.5 to 7.5% return, a 5-year lock-in period. And the last one is Equity Linked Savings Schemes. I've put the average return over here, the 3-year CAGR, which comes up to 21%, which is the highest across all these investment options, and the lowest lock-in period of only 3 years. So this makes it really favorable or attractive when it comes to other options under ATC. Okay, now we'll dive deep into what exactly ELSS mutual funds are. If you look at the asset class breakdown, okay, if you look at how this mutual fund is structured, around 80% minimum of funds are into equity when it comes to an ELSS mutual fund. The rest 20% is usually into debt, okay, but 80% of the funds minimum is into equity. So you should understand the risk exposure over here. It's not a very stable fund, okay. They are investing into equity, into the equity market, so they can be volatile as well. The second point is the lock-in period, which we need to stress upon and understand what exactly is this. A 3-year period of lock-in. After you invest, you cannot actually withdraw that ELSS money for a 3-year period. Okay. And here is why selection is also quite important. Remember, you are selecting that fund manager or that particular scheme for a 3-year period. Okay. So this can get long. It's like a long-term decision. You can't actually opt out and go into another mutual fund accordingly in that 3-year period. The next one is the structure over here, which is Flexi Cap in nature. Okay, the fund manager has no constraints on the market cap exposure. If he wants to invest more in small cap, he can do it. If he wants to invest more in mid cap or large cap, it's his selection point over here. Okay, so it's very similar to Flexi Cap funds. apart from we are getting some, benefit when it comes to ATC on ELSS mutual funds, but very similar to Flexi Cap, as to the constraints on market cap exposure, there are no constraints. Okay, we'll also dive deep into this and see if we compare a Flexi Cap and ELSS, what exactly is the difference and what's better than the other. And the last one is the 1,50,000 of taxable income. You can actually get a rebate on that, okay, under section ATC. So this is one of the main reasons people actually look into this particular ELSS mutual fund, which is because of the tax benefit. Now let's dive deep into and understand ELSS versus Flexi Cap. Okay, both the fund managers have a leeway when it comes to no market cap constraints. You can, in both these funds, you can invest up to how much ever you want in large, mid, small cap, so on and so forth. Now, before I started off this webinar, I was thinking to myself, is it worth investing in ELSS mutual funds, or should you just select a Flexi Cap fund? Because, is there higher return potential, which kind of offsets the amount of tax benefit in ELSS? But I was shocked to see the results. If you see the category average CAGR, ELSS mutual funds are actually doing much better at 21% versus a Flexi Cap mutual fund category average of 19% itself. You have to understand the double benefit over here. One is that the amount of returns is higher when it comes to an ELSS scheme, and also you're getting a tax benefit over here. Okay, so there's a double benefit versus simply entering into a Flexi Cap mutual fund. Okay, if you see the best performer, it has given 40% CAGR versus 38% in Flexi Cap. And the worst performer, your ELSS is given only 88%, the worst performer, versus a Flexi Cap fund of around 9%. So along with a tax benefit, equity returns are also being generated higher than its counterpart of a Flexi Cap mutual fund. Okay, so this thing has to get some importance because ELSS mutual funds have done better when it comes to Flexi Cap funds category average. Okay. Moving on, the next part, I've looked at the top 10 ELSS schemes on Markets Mojo. And the reason I've done that, I want to actually understand how are they allocating into different market caps, what's the top sector, how has the returns been. Okay, so this particular table over here, 10 of the top rated mutual fund ELSS schemes on Markets Mojo, we have return, we have the market cap breakdown, and also the top sector it's allocated to. Now, 3 simple observations over here so that you'll understand what exactly or how exactly ELSS mutual fund managers are investing. As I said in the start, it's Flexi Cap in approach. It can choose how much it wants to invest in what market cap. But if you see over here, large cap stocks are one of the most allocated part when it comes to these ELSS mutual funds. If you can see over here, okay, it's as high as more than 75 to 80%. Okay, now that is a benefit over here. Mid cap is slightly lower and small cap is the lowest currently. So even though the manager has some leeway, if you see they've taken a slightly conservative approach and investing most of your money into large cap schemes. Okay. So there's the risk component is slightly lesser when the manager allocates more into large cap versus a mid and small cap stocks. The second point which I've realized over here is the top sector allocation. Over here, if you see, most of the ELSS schemes have the highest allocation into private banks. There's no particular learning over here. This particular sector allocation can change as the fund managers think, you know what, now IT might perform, or let's say now FMCG might perform. They will shift their sector allocation. But at the moment, private banking is the most allocated sector when it comes to our top 10 rated ELSS schemes. And the last component, which I think is the most important over here, if you see the return, I've broken down the return into 2 different ways. One is an absolute CAGR return or a lump sum investment 3 years ago, and one is the SIP return. And if you see, there's quite a big difference when it comes to you doing an absolute investment over here, a one-time lump sum approach, versus going the SIP route. If you remember in the last particular webinar event while I was speaking, I had actually showed you all that when you invest in a bullish market versus a bearish market, which returns are actually more. If you see the trend of the last 3 years, it has been a really good bull run. So when you're investing using an SIP approach, you're actually buying at higher prices as the market is going upwards. Whereas if you simply invested one shot, you can see the CAGR returns is quite higher. Take the example of Quant Tax Plan. It has 40% CAGR in a lump sum approach, whereas only 24% in an SIP approach. Now, this should give you some idea that if you know that the market might be bullish or bearish, how exactly you would have to plan your investments. Okay, so 3 different learnings over here. One is with the return, the market cap breakdown, which is mostly into large cap, and currently private bank is the top sector. Now moving on, I want to actually put some importance over here when it comes to the selection of your ELSS scheme. Now what happens is that when we hear the word ELSS, the first thing which comes up to my mind is the tax benefit. Up to 1,50,000 of your taxable income can be exempted over here. That's not the only point when it comes to selecting an ELSS scheme, and the reason is very simple. What I've done is that I've looked at the last 3-year return performance, the absolute return performance in ELSS schemes. Okay, and out of all the ELSS schemes, I've actually broken them down into schemes that are given above 100%. You can see 13% over here, 13 schemes over here. Okay, 75 to 100 around 16 schemes, 50 to 75% return 19 schemes, and 20 to 50% only 9 schemes over here. If you see, it's well broken up. You can either be on this bracket or you can be with the top performers over here. If let's say all the funds were above 100 or all were above 75 to 100%, then there wouldn't be much difference. But here you have to be very important when it comes to selection. You might be stuck in a scheme for 3 years, which is not actually doing well. If you look at the top performer, we have Quant Tax Plan in the last 3 years, and the worst performer is Aditya Birla Sun Life Tax Plan. And the shocking part is the return difference. Quant Tax Plan has given some 175% return in the last 3 years. Aditya Birla Sun Life has only given 27%, a 148% return differential. Don't simply look at ELSS scheme, I'm going to save taxes today, so I'm putting in an ELSS scheme. Understand the importance of selection. 1,50,000 moving up by 175% versus just moving by 27% can make a big difference when it comes to investments. So the importance of selection over here should be your priority as well when it comes to an ELSS scheme. Look at funds that are showing some consistency with their returns. Just don't look at the last 1 year and say, you know what, I'm going to bet my money on this ELSS scheme. It might not be consistent in approach. Okay, so remember the importance of this particular thing when it comes to the returns. Now let's move on. What I've done is that I have actually made this thing slightly more practical for you. I've created this Excel worksheet which will give you some idea on how you can actually, save some of your taxes when it comes to ELSS mutual funds. Okay, I'll take you to that particular Excel sheet. It's really simple. Okay, so I'm sharing my screen over here. If you can see this particular Excel sheet I've made over here, you have to simply enter your income over here, the yearly income. It can be salaried or the business income. Okay, and it will automatically tell you how much ELSS investment you should make. For example, I've entered 3 lakh over here, and if you see, it's asked you to make a 50,000 ELSS investment, and this is your taxable income post the ELSS investment. On the second table, you can see over here, without the ELSS investment, what's the tax you have to pay, and with an ELSS investment, what's the total tax you need to pay. Okay, so this is a sample worksheet. Please understand, you will have to consult your CA before taking any tax-related advice. I've tried to make this a bit simple for you so that you get some idea. Mehtab, if you don't mind, just simply put the link of this Excel sheet just below the video. So if anyone of you all want to refer it later, it's below the video. I'll also send you an email later after this event for you to actually understand this. Now let's say you're earning around, let's say 10 lakhs a year. Now it will ask you to make 1,50,000, which is the maximum limit of ELSS investment. And if you see, without the ELSS investment, this is the tax. And with, it's 82,500. So you're saving around 30,000 when it comes to this. Now, if you understand, this is as per the old tax slabs, not the new tax regime. Okay, so that's why I'm saying do consult your CA, don't just run with this Excel sheet and start off with investments. Slightly below, it also helps you with the monthly SIP amount, or if you have to go with a lump sum investment. So you get some idea at the start of the financial year that, okay, I have to make 1,50,000. So I will now break it into 12 different SIP options. And throughout the year, I will every month invest 12,500 into an ELSS scheme. Okay, so you can actually put your amount over here, whatever it might be. So you get some idea as to how much ELSS investment you should make. Okay, it will automatically calculate that and give you some idea of as to how much ELSS investment you should make. Okay, so for example, a very simple one, 8 lakh income yearly, it is asking you to make 1,50,000. You're saving around 30,000 on an 8 lakh salary. Okay, so you'll have seen the cheat sheet. It's available just below the video as well. And I will also send you an email post this event to actually go back and actually check how much is the ELSS investment planning you should make for the next financial year. Okay. Now let's move on. In the start of the event, I made a particular statement that tax saving or tax planning is one of the most least prioritized part of our financial planning journey. This particular chart over here is the net inflow into ELSS schemes in crores Okay, I have taken the last year period. And I say net inflow, it considers the amount of money coming into ELSS mutual funds and the amount of money withdrawn from mutual fund schemes. If you see this particular chart over here, Jan, Feb, March is one period when we see the highest inflow into ELSS schemes. Most of us are a bit worried over here. We know it's the last date coming up, so we push in a lot of money, and this amount drops very fast in the April period. And this is not just last year. If you see year on year, March is the most favorite month when it comes for investors to invest into ELSS scheme. My point here, the point I'm trying to make is that March period might not be the best month for the equity market. It might be the top of a bull run or so on and so forth. So don't simply rush when it comes to the end of the financial year. At the start in April next month itself, plan your investments so that you can either look at an SIP, a mix of an SIP lump sum approach, and not simply rush to the March period when it comes to ELSS investments. Trust me, March might not be the best month. If you look at the past 3 years, March turned out to be the best month, especially March 2020 COVID, when the market was at an all-time low. But going forward, that trend might not follow. It might be possible that March is the peak of the equity market cycle, so you will have to buy at a really high price or invest at a really high NAV with the ELSS mutual funds. Don't follow the crowd. The crowd is simply running towards the end. You can plan your investments. I've sent you an Excel sheet. You all can simply plan it month on month, or let's say, a few months prior to simply rushing in and investing in March. Okay, this source was from Amphi. Now moving on, some of the top, as I've promised, some of the top rated ELSS schemes on Markets Mojo. We have IDFC Mutual Tax Advantage, which has given some 27% 3-year CAGR. Okay, we have Quant Tax Plan, which has also given 40% 3-year CAGR. It looks very favorable. And lastly, the PPFAS Mutual Fund, Parag Parikh Tax Saver, which has given some 26% 3-year CAGR. Now you all can also go on the site and actually see how these particular mutual funds are performing. Okay, so I'll simply take you to the mutual fund section. Okay, you can search any of them over here. So Quant Tax Plan is currently ranked number 2. Okay, and you can see 40% CAGR as I've showed you, and you can see the fund size over here. What normally people do is that they rush into the fund which has the highest AUM size. Most probably because many people are following it and it looks comparatively safer. Okay, so people normally rush looking at the AUM size, but there are other factors we should look at. If you're an investor at Markets Mojo, you can also look at the beta, the volatility, and the drawdown. I also covered this extensively in the last event. And if you see the risk adjusted returns, it's quite good at 2.01. Most of the mutual funds have around 1, 1.2, so on and so forth. This is 2.01, so it's really good risk adjusted returns. And you can also see things like how consistent it has been. Okay, remember this fund has only underperformed in the last March to September period. Otherwise, it is outperforming consistently. Okay, you can also look at the amount of outperformance is quite good. For example, 35% versus 16%, 2x outperformance. Look at this outperformance, 32% versus 9%. So just not about the tax benefit, ELSS mutual funds can actually be good wealth creating instruments. Okay, so simply just taking your 1,50,000 and pushing it into an ELSS scheme for tax benefits should not be your only approach. You can look at the amount of returns generated. Okay, and as I've said, okay, see, for example, bank public is the highest sector over here. And one thing I've noticed is that most of these ELSS mutual funds invest in large cap, still with good return potential. So it's something you should watch out for. Okay, so now we've kind of understood what exactly are ELSS mutual fund schemes, how are they designed, when you should invest, how you should follow what approach. Now let's move on to some strategies on how you can actually invest in ELSS mutual fund schemes. What are the different strategies I've thought of? Okay, the first one is that how 3 years of disciplined investment can be your lifetime tax savings. If you invest in a disciplined manner for the next 3 years, let's say you're not actually planned off your ELSS investments. If you invest in a disciplined manner for the next 3 years, you might not have to invest from the 4th year. And the reason for that is very simple. Let's say you have an SIP into an ELSS for a 3-year period. Month on month SIP, so 12 into 3, 36 months. Okay, continuous SIP investments. We've spoken about the 3-year lock-in period. So the first investment you make as an SIP will be available after 3 years. The second investment again after 3 years, so on and so forth. So let's say after 3 years, you can try an STP. What exactly is this? It's a transfer plan. So from one mutual fund, you can actually transfer it into another best performing mutual fund scheme accordingly. Okay, so what you can do, you can STP your ELSS investment from the 37th month, that's after the 3-year lock-in period, and start putting it into a better mutual fund scheme. So you can see this would create a self-sustaining model or a cycle where you don't have to again collect money in the 4th year. Or your ELSS investments from the 1st year start moving to the 4th year and you don't have to worry about generating more income. Now, one thing we'll have to agree is that your salary keeps on increasing year on year as well. I don't, disagree on that. So you don't have to worry about that because the SIP investment you make into an ELSS scheme will also have some capital appreciation. So that SIP amount will also become bigger. You can withdraw a bigger amount and then you can also invest more into ELSS schemes. So it will offset any greater taxable income you might generate as your salary keeps on increasing. If this is slightly complex for you, I've made a small chart in the next particular slide. If you see year 1, we are making 12 SIP investments, which comes up to around, let's say 80,000. Okay, let's consider these blocks as an SIP investment. Year 2, again, you're making 12 disciplined monthly investments. And year 3 as well, you can only see that the amount of investment might increase as your salary keeps on increasing. You can use the Excel sheet to calculate it, but your investment to make would be slightly increasing. You don't have to worry because this particular investments it'll be available to make an investment after the 3-year lock-in period. So in your year 4, you can actually take that SIP and push it into the year 4 investment. So it will be a cycle. The next year again, you can take this particular investment after the lock-in period and put it over here. So only 3 years of investment, and for the entire lifetime, you will have your SIP into ELSS equity schemes going forward. Okay, so this is exactly what I meant by 3 years of disciplined investment, which sums up to your lifetime tax savings. Similarly, the next one, this particular SIP can also come here, and there'll be a proper cycle going here for year 4. So only 3 years of investment, and you're done with your entire tax planning for your life. Okay, this is subject to what changes come in the next budget and the budget following that. But assuming that for the next few years, this particular ATC option is available, you can plan your investments accordingly. This is strategy number 1. Now, we do get a bit worried when we hear the 3-year lock-in period. Now, 3 years is a very big period. I mean, it's 36 months sounds easy when I say it, but it's a really long time. What if you've invested in an ELSS and there's some emergency situation? Let's say you need to withdraw some amount of money, or there's a real big emergency where you have to actually get some amount of money back. We can't actually go back to the ELSS mutual fund and ask them, let's say a premature withdrawal. It's not possible. For 3 years after you invest, you have to forget about it. I don't know if many of you all know about this particular option, which is loan against mutual funds. Okay, so many banks and NBFCs provide a loan against your investments. The loan amount is approximately 50 to 60% of the investment value, and the interest ranges from 9 to 10%. Now, understand the benefit of this. You're posting your collateral as a mutual fund investment, and you can take some amount as loan outside, in an emergency situation. Okay, and the lowest loan amount is around 50,000, and a maximum limit of up to 20 lakh can be taken in case of equity mutual funds and 1 crore in case of debt mutual funds. For the very simple reason, because debt funds are a bit stable in nature. So the collateral you post is slightly stable, so banks can give you a bit more amount when it comes to something which is risky as an equity mutual fund. Okay, since they are secured by a collateral which is your mutual fund, loans against mutual fund interest rates are lower than, for example, credit cards. Okay, now I don't want you all to exploit this. What I meant by that is don't go on investing and then start taking loans on this. This is more for an emergency situation. You can't simply use this strategy because you're getting a loan. Okay, but many investors get lost because after they invest, they forget the money for 3 years. In case of an emergency situation, you can opt for this route. Okay, so this could be beneficial if you have an emergency situation coming up. And since you're posting a collateral, as it said, the interest rates could be lower over here. Okay, so now we're done with these 2 particular strategies over here. We've also understood kind of what exactly is an ELSS mutual fund now. So with that, some of the important points you need to remember before simply going ahead. Okay, there are just 5-6 important points. The first one is that avoid the timing risk. As I said, the final week of March might not be the best time. Plan early and execute it accordingly. Okay, don't simply go at the end of the financial year and rush to buy ELSS mutual funds. You can plan them well in advance. The second point is the top quality selection. The difference between the top and the worst fund can be as high as 148%. So you have to keep an eye over here. Don't simply run to buy any ELSS mutual fund scheme just because it's an ELSS mutual fund. Understand the return potential can also be extremely high. The third point over here is don't invest and forget. After your 3-year lock-in period, you can always look at the other best ELSS mutual funds available and then start an STP or simply withdraw the money and then push it into another ELSS mutual fund scheme. Don't simply invest and forget after 6, 7, 8 years that, you know what, I've invested and forget about it. Understand that amount of capital can also be put into the next best mutual fund or into another mutual fund scheme, so on and so forth. So after 3 years, always look back at them. Okay, 2 other important things which is happening. If you look at the budget change over here, now some of you might not understand this, but under the new tax regime, the tax exemption is now at 7 lakh per year versus 5 lakh. What's happening because of this is that many people might now ignore the old tax, which allows you to get some benefit with ATC, and simply go to the new tax regime. Because up to 7 lakhs, you're getting a direct rebate over here. Okay, so this can impact the flows into the ELSS segment. Many of the investors in the market have also said that this can see a major shift from the old tax to investors opting for the new tax regime. Okay, because of the exemption when it comes to 7 lakh per year versus 5 lakh, which was previously allowed. Consult your chartered accountant before making any investments like this, because it might be possible that you're benefiting more from the new tax regime. I'm not simply come here to sell you some ELSS mutual funds. If you're getting benefit with the new tax regime due to lower tax rate, you can consider that as well. Second and the last point over here is some recent news which came out in Jan. SEBI has now allowed mutual fund houses to have passive ELSS schemes. If you remember in my mutual fund event, I have spoken about active versus passive mutual funds. An active fund where the manager himself selects the equities stocks to invest in or himself looks at the market cap exposure, versus a passive ELSS scheme where the goal of the fund manager is simply to mimic the index. So it can be possible that you can invest in a passive ELSS scheme. There are a couple of benefits. The low expense ratio. Since the fund manager is not going to use his stock picking approach, the expense would be lower when it comes to a passive ELSS scheme. Okay, and also the risk associated would be slightly lower because I think an active fund manager might go aggressive into small cap or might go aggressive into mid cap. In a passive fund, you're simply mimicking the benchmark. Okay, so you would have a low beta, a low standard deviation. Keep an eye for these if you think there can be a passive ELSS scheme. Let's say you're allocated very high into the equity market. You might not want to, then also give new money to a fund manager who might use his stock picking approach. For those investors, passive ELSS scheme can be a good option to look for an ELSS investment. Okay, so these are the important points to remember. We're done with the strategies and the ELSS mutual funds. With that, I would ask Mehtab to ask me any questions regarding to ELSS mutual funds.
The first question for today is from Mr. Swapnil. Can I invest just one time lump sum in ELSS?
You can do that. If you would have done that 3 years ago, it would have been better as well, because as I said, it's all about how the market's turning out to be. If it is a choppy, volatile or a very bearish market, an SIP approach would be better. And if it's a bullish, a structural bull run, if you believe the market will go up very handsomely over the next few years, your one-time investment would be much better. There's one problem where when you do a one-time investment, then you have to forget for it about 3 years. What you can instead do is, let's say, have a quarterly investment. So you invest in one ELSS scheme and another ELSS scheme over here. So you can invest in 2 ELSS schemes as well. Okay, so a one-time approach is fine, and it totally depends on how you see the market unfolding over the next few months as well.
The next question is from Mr. Shyam Dasari. Dear Jason, don't you think in the current atmosphere where there is uncertainty in equity markets, investing in ELSS is proper? It has got a lock-in period of 3 years. ELSS is for tax benefit, but returns are not made, then there would not be any use in ELSS right now. Maybe investing in thematic funds like infra, etc., which may be presently trending, may be a good choice, even though they would not save taxes.
Okay. So in the current atmosphere, you're saying there is uncertainty. The last 3 years were not, very certain. We had March 2020 COVID happening. We had, continuous increase in the Fed rate hikes, so on and so forth. still those ELSS mutual fund schemes have done handsomely well. Okay, so it's not that, the next 3 years or the next few years might be really volatile, so you all can't consider ELSS mutual funds. Understand that the fund managers have done a relatively good job over the last 3 years. You're right that it has got a 3-year lock-in period. So once you put in your money, you'll have to forget about it. But investing in thematic funds is much riskier. If you're game for that risk, if you can actually, sum up that particular risk, you can go for thematic funds. Now, you'll also have to understand that if, let's say, you don't opt for the old tax regime and simply go to the new tax regime, then you might be able to actually play around because you don't require ELSS funds. But if you say that ELSS is for only tax benefit, returns are not made there, I think that's a very harsh statement. Some of the ELSS, like look at Quant Tax Plan or the other ones, they've given 28 to 30, 40% CAGR. That's a very good amount, okay? Considering the amount of risk or volatility, they are only investing mostly into large and mid caps, and still they've given some good return potential. That shows the good, the good quality stock picking. So this is one misconception we can remove from here. You might say that ELSS is simply for taxes, but if you look at the top ones, they've done handsomely well. Okay, and saying things like, the current atmosphere has some uncertainty. The last 3 years were not, that certain as well. There was uncertainty. So it totally depends on where you break even. If you can not invest in ELSS and still save on taxes with the new tax regime, it's good to go forward to. And investing in thematic funds does carry a lot of risks. So, infra might be a really good trending choice over here right now and not save taxes, but it totally depends on the returns you make as well.
The next question is from Mr. Kaushal. Is Quant Tax Fund still a good choice? They had exposure to some Adani Group stocks, which probably they have exited.
Yeah, they have made some exit. I've read the news about as well. And it's still showing number 2 on our, ranking system. Understand that even though Adani stocks have been corrected, Quant Tax Plan would get a hit. But apart from just one story, we are also looking at many other factors when it comes to the Quant Tax Fund. We are looking at their portfolio as well, the composition, how good are those stocks. We're also looking at the risk and the return potential. So just looking at one particular story should not be your entire final goal. Okay, you can also look at how those funds have done. They've also picked other better stocks as well when it comes to their investment. It's ranked number 2. It's a good buy. You can actually go for it.
The next question is from Mr. Parag. Jason, you said no tax up to 1,50,000. But if this 1,50,000 is used in PPF, then where is the tax benefit?
Totally agreed. I mean, 1,50,000 is on all the ATC investment options. If you've used 1,50,000 in PPF, then investing in ELSS does not make sense because you're done with your Section ATC investments. Your point is right, sir. If you're already putting 1,50,000, see, don't look at ELSS at 1,50,000 and PPF as 1 lakh. Understand those 7 different instruments I showed. All of them, including all of them, it's up to 1,50,000. So if you invested 1,50,000 into PPFs, then investing in ELSS schemes won't be useful because you're already getting a rebate on that 1,50,000. So your point is right, sir.
The next question is from Mr. Mohit. How is PGIM ELSS fund?
Okay, let's look at that on the website. So for example, if you simply go on PGIM ELSS fund. Okay, so it's hold at rank 4, very close to the buy category of rank 3. It's rank 4 over here. Okay, and if you simply just go below, so one thing is that it's been for 7 years in the industry. If you look at the return versus the benchmark, it has done slightly above the benchmark. You look at the 4-year period, it's given 16.98 CAGR. 2-year, 1 year is slightly underperforming. It is outperforming the peer average, but not the benchmark over here, which is Nifty 500 TRI. Let's look at the consistency as well. Has it been very consistent when it comes to returns? I think my mouse is slightly not working. I'll just refresh the page. Yeah. Here you can see 2 periods of underperformance. Ideally, it should be outperforming all. We saw Quant Tax Plan, which is outperforming each of them. Okay, and when you see it as outperform, it's not a very big margin. So, for example, 36%, 35 over here, 18%, 16.9 over here. So, not a very big differential. If you look at the risk exposure, it's good in all 3, all 3 parameters: low beta, low volatility, and low drawdown. So it's less riskier, I would say. Okay, so medium risk, medium return over here, one thing you should pay attention to. So if you're still looking at this particular fund, you can go into the top 3 instead. Parag Parikh looks more attractive when it comes to PGIM. Okay, and if you're already invested, you can simply hold on to it. You don't have to rush and then look at a different. But let's say your 3-year lock-in period is over, then you can look at these 3 different mutual fund schemes.
The next question is from Ms. Shilpi. Kindly recommend ELSS for investment and tax savings.
I've showed them on the slide, ma'am. So you can simply go for the 3 ones I've showed, which are IDFC Tax Advantage, Quant Tax Plan, or PPFAS Tax Saver Fund. Apart from these, the other ones, I don't think so you should go up to, because we have 3 buy rated ones over here. So you can simply move on and buy those particular fund schemes.
The next question is from Mr. Rakesh. On your site, IDFC tax savings scheme is rated 1. Which scheme do you feel is better under ELSS, IDFC or PPFS?
Could you just flash the question if you don't mind? So saying IDFC is ranked 1 and PPFS is ranked 3. Or ideally go with the top ranked one instead of going for PPFAS. If you have a choice between those, you have to go for the top number 1 rated ones. Just a disclaimer, personally, I have also invested in PPFAS Tax Saver Fund, I think a year or 2 ago. And I'm lucky that it has actually given return. Now, I can't move out of that fund unless after 3 years. If you have a choice, simply go for the rank number 1 and across any category. It's not about ELSS as well. If we believe that the top ranked, that's why I ranked it number 1. So if you have a choice, simply go for the rank number 1.
The next question is from Mr. Neeraj. Can you please explain the active and passive mutual fund / ELSS?
Yeah, sure. Very simple. In an active mutual fund, the job of the fund manager is to actively look at stocks, market cap exposures, and take a decision. So you have to understand there's some amount of bias. This could be higher risk as well, because he is himself going to say, you know what, I think now private banking will do well. Under private banking, I think mid cap will do well. So he makes those selections. He's actively managing them. Passive funds simply look at mimicking the benchmark. So let's say Nifty 500 is a benchmark. A passive fund will aim to give as much as returns and volatility as that particular benchmark. When it comes to the fees you pay, active funds slightly higher fee because the manager is doing some effort. He himself is going and searching stocks. But passive would be less amount of fees because it's left automated. The fund itself is trying to mimic the benchmark. Risk portion as well is slightly higher in active versus a passive mutual fund or an ELSS scheme. If you want to select any of them, it totally depends on your approach. Are you happy with benchmark returns and don't want much risk? Then you can go for a passive option. But if let's say you want to actually give your money to an active fund manager, you believe that he can generate alpha, that's when you look at an active approach.
The next question is from Ms. Shibu. Hey Jason, whether STP option is available in Markets Mojo mutual fund segment?
Currently, STP option is not available. Our team is working on that particular thing. There's a redeem option available. STP won't take much time. We'll be shortly incorporating that as well. And along with STP, there will be many other features like analysis, mutual fund portfolios coming up, and many strategies. So soon, in the next few phases, we'll also be having an STP option.
The next question is from Mr. Patra. Income from ELSS is taxable?
So above 1 lakh of your capital gain is actually taxable. Below 1 lakh is tax exempt. So you have to understand, if you invest, let's say 1,50,000, and from 1,50,000 that amount becomes, let's say 2 lakhs. So if you earn 50,000, that's not actually taxable. But above 1 lakh is actually taxable. So people also consider that actually, because in a 3-year period, if you invest 1,50,000, it might become 3 lakhs as well. So let's say from 1,50,000 has become 3 lakhs. So you made a gain of 1,50,000. That 50,000 will be taxable. The rest 1 lakh will be tax exempt. So above 1 lakh, yes, it is taxable.
The next question is from Mr. Shamim. How to find which mutual funds performing well using all category?
All category, currently we don't have an option of all category. We've actually given, the best mutual fund across all categories is the wrong way to look at it. So for example, if you want the best mutual fund across all categories, your answer might go to, a small cap mutual fund, or probably because it has high return. But when you understand a mutual fund comparison should be done within the same category because it has similar risk profiles, okay, similar approaches followed by the fund manager. So simply, so when you win a stock, when you pick a stock, you don't say, I'm going to pick this particular microcap stock because the return potential is good. Microcap stocks have higher risk. Similarly, a small cap mutual fund will have a higher risk. It's good to look at it within categories, and simply look at all categories does not actually make sense because one fund might be doing extremely good, but it will be a small cap, so it has higher risk. And one fund which might not be doing good, it might be a large cap fund. So looking at all categories, I don't think is the correct approach when it comes to mutual fund investments.
The next question is from Mr. Nilesh. Hi Jason, can you please help to explain how to understand risk adjusted?
Yeah, risk adjusted is quite simple. If I just share my screen over here. So what happens over here, if you look at this particular thing over here, on the numerator, we have returns 3 years. Okay, so this fund has given some 25% return. And on the benchmark, we have the returns for the last 3 years. Then if you look at the last 3 year volatility, it's 15.44, which is nothing but the standard deviation over here. And 16.93 when it comes to the benchmark. Risk adjusted is just a division. Okay, you have this in the numerator, this in the denominator, and you get 1.62. So if your fund is making higher return, how much risk is it taking to generate the return is over here. So you divide the two and you reach to 1.62 over here. The higher the number, the better. Okay, so if this is higher than the benchmark, then you know that you're getting a superior risk adjusted return versus the benchmark. So especially in mutual funds or let's say, a particular PMS house, people normally look at risk adjusted. On the basis of this, we have other ratios like Sharpe ratio, we have the trainer ratio, so on and so forth. Yeah.
So the last question for today is from Mr. Johnson. Will it be better to diversify into the 3 funds? What should be the ratio based on then?
I mean, diversifying into 3 funds, you can do that. I don't see the purpose behind doing that because if you see most of the ELSS mutual funds, the top rated ones, are putting their money into large cap. Most of them are also highly allocated into private banks. If you ask me personally, you can diversify, let's say, into 2. Doing the 3rd or 4th or adding more of them wouldn't actually be an optimal approach because, I mean, if you believe the fund manager will do well, ideally you should give him most of your money and then to simply, over diversifying and buying many ELSS mutual fund schemes. You can still do into 3 funds. I'm not stopping you over there. The ratio, ideally, you should mix it into 1:3. I mean, you don't have to, if you think that one mutual fund can do better, that's when you increase your ratio. If you want, you can just take the 3 best ELSS mutual fund schemes and every 3rd month, you can simply put an SIP into that or break it down into 1/3 and put it. This kind of decreases the amount of risk you're taking. Now, the point you raised here is quite fine because you're giving that money to the mutual fund manager for a 3-year period. So if he doesn't perform for 3 years, your money is locked in. So let's say you give it to 3 different ELSS funds, 1/3, 1/3, 1/3. So even if one doesn't perform, you're not that upset because the other 2 might actually perform well. So even I had put a lot of my ELSS investments into Axis long-term equity fund. It's not performed well. It's currently sell-rated as well. But now I'm stuck because I have a 3-year lock-in period. If I was in your place and I would do the right approach of, let's say, putting into 2 or 3, then it would be beneficial. So your point is raised is fine, so you can actually try that out and look at the top ones to actually know which ones to put in your money. So I think that's it with the Q&A session. Thanks a lot for coming for this particular event. I hope you all got some understanding on what exactly are ELSS mutual funds. The link is available just below the video for you to go and actually calculate your ELSS investments. We'll also be shortly sending you an email with that ELSS worksheet. And do send across any particular feedback if you have. If you want me to explain some other different category in the mutual fund, you can also please write it down in the chat box. Looking forward to seeing you all come for the events in the future as well. Goodbye and have a great weekend. Thank you so much.